All right, so I need your help. I give about 100 presentations a year to investors, and I gave half a dozen of them. Earlier this week, I was at the Bank of America Merrill Lynch conference in New York and at the Sandler O'Neill conference in Palm Beach last week, and it's just what I do every once, twice, 3 times a week. And I'll tell you, I really struggled trying to figure out what I was going to talk about here today. For a couple of reasons. One is it's emotional for me to come back here, and I'll tell you my background and how I got to Florida and what it means to me, but it means a lot. I haven't only been back here twice in 35 years. Came back 10 years ago to recruit some students. Joel Houston was very helpful to me. But I've changed jobs, moved around a little bit, and I just haven't had the opportunity to really come back and just walking through here. Number one, it's great to see things that have such great memories, but it's also incredibly impressive to see what the school has done. It's a good school then, very good school, but it's an outstanding, excellent school now, and each of you is very impressive. So I'm glad to be here in front of you. So why did I struggle? 2 reasons I came here today. One is my daughter, Lauren, is a junior in high school, and in our house there's really only one school to consider. My wife doesn't agree with that, but I wanted the opportunity to bring her back here and see it a little bit. Sort of hidden motivation was I wanted to bring her here and tell her what an excellent student I was and let her meet all you and see what that meant. And unfortunately, someone, Stella Davis, earlier today told me that transcripts really are still around from 35 years ago, so I wasn't able to pull that off. I actually wasn't a great student, but I got a great education. So that was one reason I wanted to come. But the other reason, and I mean this genuinely, is I really hope that what I can do today in a couple of hours, an hour and a half, however long you have, is in a very tiny way helpful to you. Because Florida changed my life. And so I think back, I had great professors, lots of great lectures, got to see a lot of interesting people. So if there's anything I can do today that you can walk away with just one phrase or one thing that makes you think a little bit and it's helpful to you, then I'll be very happy. So let me tell you what I intended to speak about. And I'm already going to change this up a little bit, because I put these slides together thinking, number one, as Dave said, I started Capital Bank 6 years ago. We're a commercial bank, a regional bank, 150 branches in the Southeast. I'll talk a little bit about the company. But Kelly had already told me, Dave told me, and then I just had lunch with 4 very impressive folks who made it very clear to me, nobody wants to be a commercial banker, nobody cares about commercial banking, it's boring, everyone wants to be an investor. So I'm going to balance that a little bit. I think what I'm going to tell you is there's a lot of change in banking. And let's see, I need to click this up here. So what I think I will do, keyboard. Okay. One of the things I was going to tell you about is I started a technology company early in my career. As my daughter loves to tell me, is I really don't even know how to use it. So I'm going to talk for just 2 minutes about Capital Bank, what it is, what my experience was starting it, in really just 2 minutes unless there's interest there. And it has really nothing to do with the company. If anybody's interested in going to work for Capital Bank, I'm happy to talk to you. But the real purpose there is, was an entrepreneurial venture. When I'm 56, I started the business when I was 50. Had a lot of experience, interesting experience, some successes in my career, a lot of struggles, believe me. And so it was a big risk for me to go out and start a bank, especially 6 years ago when the world was ending and banking was in flames. And it's been an interesting process, and the bank is successful and it's done well, but it's been a tough grind. So if there's interest there, I'll spend a few more minutes on that. I'll talk about my bio and my background, again, just as a thought starter. If someone's interested in some part of that, I'd like you to know what I did. My career has really been split up in thirds. I spent my first third in high-tech aerospace companies, the second third really in the industrial sector, and then banking in the last part of it, or at least up till now. Hopefully it's not the last part. I haven't checked our stock price today. I'll give you a couple of thoughts on the economy and the job market. I think it sounds like you all pretty much know what you're doing. If you're a junior or a senior, if you're a sophomore, you probably have a pretty good idea. I think the job market right now, boy, it's getting better every day. And for folks like you, it's probably red hot. So I wouldn't, if I were making this presentation somewhere else, people might have some concerns. But I'll just give you a couple of slides quickly and give you my view on that. And again, one of the things you'll learn about me is I'm happy to share my opinion. I've got an opinion on everything, even things I know nothing about. And I don't feel bound by facts. So I'll tell you what I think. And if you like it, that's good. I wouldn't, don't make any decisions based on what I say. I've got a slide in here that's titled The Path to Being a CFO. There really isn't a path to being a CFO in a big corporation. I'll tell you about my experience. And the slide really just shows you what my team looks like today in our small company and really what the skill sets are in different jobs. And I think part of knowing if you want to have this job, how are you going to get the critical jobs underneath is important, and what skills you need. It's probably obvious, but I'll share it with you. Next slide says investment banking versus commercial banking. I won't even try to make that trade. I'll talk a little bit about it, but most importantly, both of those industries, all of financial services is undergoing enormous change. And so if you decided you want to go into investment banking a few years ago, when you show up in a year or 5 years or 10 years from now, it's going to be a lot different. And that doesn't mean it's good or bad, it just means there's change. And if you want to thrive in a industry that's going through change, and by the way, I would never work in any industry that wasn't going through change. I wouldn't even consider a job in a staid, established, steady industry. That's just me. So I don't want to say anything that would sound discouraging. Just knowing there's change and being able to anticipate the change and actually prepare for the change means you may actually be able to take advantage of it. So I'll talk a little bit about that. And then I've got some slides I can already tell are completely wasted. Preparing for your first year, you guys already know everything on there. But I am going to spend 1 minute on the last slide only because when I was in business school, I went through a workshop one weekend with a professor, and at the time I thought it was a complete waste of time. And over time, it's been the most important thing I did. And we don't have the time to go through it. I'm just going to spend 5 minutes on it to give you an idea of what the exercise was. And I go back to it all the time. It's caused me to change jobs. It's changed me to do things differently. And I think it's very simple and it's obvious, but it's worth me standing here and making you listen for 5 minutes. I think you'll get something out of it. If I go through my slides, all of them, it's going to be a very boring presentation. Right? They're not that good. So I'd ask you, I'd really plead with you to ask some questions. Stop me along the way at any time. Just raise your hand, speak out. It'll be a good session if we really get to the point where you're asking some questions, because I'm not here as an expert in anything. I've had a lot of experience. I've worked in a bunch of different industries. I've worked in global companies. I've worked in small companies. I've started companies. Some were big successes. I'm going to talk about those. The other ones I'm not going to mention. But ask me some questions, and at least you'll get what my experience was. And I promise you, there's no question I'll be uncomfortable answering, and I'll be brutally candid with you, again, with my opinion of what that was like. And if it's helpful, that'll be good. So let me take this back here. So we'll start with Capital Bank. As Dave said, we started this bank 6 years ago, regional commercial bank. I'll go through my bio, and I probably should have put this in a different order, but I wanted to get the commercial out of the way. As the financial crisis was hitting, it was very clear that there was going to be carnage. I mean, there's 7,500 banks in the country. A lot of them, like 1,000, might not survive. There's going to be radical change, and that'll be a theme that I harp on because just for me personally, where I've found opportunity is going to industries or going to areas that were going through a lot of change, because with change comes opportunity, right? So I saw that there was going to be this carnage. I left a bank in the Midwest and joined Blackstone, a big private equity firm, with the goal of, I went there as an advisor to them to help them look at some investments, but I really went there because they offered to help me put together an investment group to raise some money to invest in banks. I spent a year or so doing that, only to realize the Fed was never going to allow us to do it. They didn't want private equity owning banks. And so I had a colleague of mine I had previously worked for at Bank of America. He'd been the vice chairman of B of A. I was at Blackstone. He was at Fortress, another private equity firm, doing the exact same thing. We were living in Charlotte. We live a mile away. There's a law, the Bank Holding Company Act of 1933 says that if you have a controlling interest in a bank, you've got to serve as a source of strength to that bank. If the bank fails, all your assets have got to come in and backstop the bank. Private equity was never going to do that. So they would have allowed them, if Blackstone was going to put their $100 billion of equity behind the bank, they would have allowed them, but that wasn't the way it was going to work. They would just wanted to have and control a bank as a separate entity, a separate carve-out. The Fed wouldn't allow it. It was a gamble, because at the time, I mean, the law was clear, but I thought, incorrectly, things were so bad, the government was so desperate, and for a while, and you all know the story, but just having been there, it was bad, right? It was really bad. You didn't know from one week to the next who was going to survive. Everyone wants to talk about Lehman, but there were 100 other companies that were going down the tubes. So it was a gamble that the Fed might blink and let private equity come in, but nonetheless they wouldn't. But thanks for the question. Anyway, I was living in Charlotte, commuting to New York, trying to do this for a year. We were going nowhere. My now partner, our CEO, was doing the same thing. We'd get on the same plane every Monday morning, compare notes, ask me how I was doing. I was saying, great. We're going to get a deal done any day. How are you doing? We might even get a deal done today. So we'd BS each other every week. We were going absolutely nowhere. After a year, one of our investors called and said, I don't know why you guys don't just try to put a business plan together, raise some money on your own. And this is the luck part. We just happened to choose the right time. We both decided to meet for lunch on a Wednesday. Anybody spend a lot of time in New York City? Route 57. Route 57, we sat there. It was equidistant between our two offices. And in 2 hours, we decided to go back and quit our jobs and try to raise some money. That was on a Wednesday. We kicked off a fundraising on a Monday. And in 2 weeks, we raised $1 billion. Now, I'd like you all to think that these guys are so impressive, they could just snap their fingers and get $1 billion. And it wasn't that at all. It was people were so desperate, and they saw this opportunity. And it's more a sign of the times that people were willing, some big, impressive firms were willing to give us $1 billion in cash, not callable capital, cash wired into a bank account, to two guys that at the time were working out of a 9-by-10 office with one desk and one phone that didn't even have a speaker on it. We had our first board meeting on my iPhone. It was not impressive. But nonetheless, we went out. We had a simple plan, which was to buy distressed banks, undercapitalized banks, failed banks through the FDIC, but banks that were in good markets and banks that we felt could be rehabilitated. We had the good fortune of having worked for Bank of America and this is before Countrywide and before U.S. Trust and before Merrill Lynch. Bank of America actually was the best bank in the country in a lot of metrics. And it was firing on all cylinders, and you know, it was a different time. And we had senior jobs. Gene was the vice chairman of the Corporate Investment Bank. I worked for him as the CFO of the Consumer and Commercial Bank, and then the chief operating officer of that business. So we had senior jobs, but in a company that size, that meant you had tens of thousands of teammates that were contributing. And the best I can say, the most honest thing I could say, we could see lots of things getting tested. We had so many resources that we threw money at everything. A lot of things didn't work, but we saw what did work. And so it was very easy for us to say, all right, we saw those 50 experiments. We're going to take the 2 successful ones that have the highest probability. We'll buy these little crappy banks and we'll just stick those things in there. And, you know, it's like going from the Yankees to, you know, the minor leagues. And that was our business plan. We said we'd take underperforming banks, we'll buy them below book value because that's where they were trading. People didn't know what they were worth. Right? The economy was in tatters. There was panic. Everyone knew that things were bad, but they didn't know how bad they were going to get. And so collateral values really didn't mean anything. And so banks were trading well below what their burn down value was, which is, you know, doesn't make sense, but in periods of rapid change, that often happens. So we said, we'll buy these banks that are losing money at below book value, and we'll just use these tested things and we'll get them to average performance. If we can get them average performance, we'll get an average multiple, and that's how we'll make the money. So, well, we were dumb enough to think we'd take any distressed bank because they're simple little banks, right? And you know, part of it is we do have experience and we did know how to do it, and we had bought banks before and turned them around, and so it wasn't 100% success, but we thought pretty much we could take any little distressed bank coming from a bank with a $2 trillion asset balance sheet to a bank with a $1 billion asset balance sheet. I mean, it's orders of magnitude. So what needed to get done was pretty simple. Now, I'm telling you what we thought we could do. So we said 5 years ago, we're going to look at these banks. We're going to buy them in the best markets. In fact, I'll go to that slide in just a second. But let me just come back to that and give you a full answer. Average performance historically was 100 basis points of ROA. You earn 1% on assets. And if you have, historically, you had 8% equity, that meant you got a 12, 13% ROE. And if you did that, you traded at a 2 multiple, 2 times tangible book. That's how simple valuation is for banks. So if you can buy a bank below tangible book and get it to average performance, and it trades at 2 times, you double your money. And so we said in 5 years, we'll do that. We'll take these banks, we'll get them to average performance in 5 years, and we'll trade at 2 times tangible book. Now, it just so happens we're in the 4th quarter of our 5th year. And we're going to end the year at 100 basis points. Pretty good. A lot of luck involved. We're not quite at 2 times tangible book, but we're rapidly closing in on it. And to really give you a good answer, how do we know we would do it? We weren't sure we would do it. That was the math that worked. We didn't know if we could do 100 basis points or 90 or 8. We knew we could improve the performance. Because a lot of the things we knew in these banks is there really wasn't that much wrong if we just recapitalized them and took fear out. Right? They were trading below tangible book, even though the fundamentals didn't suggest that. So we just said, we got $1 billion. If I buy this bank that's, you know, thinly capitalized and just over-capitalize it and just take any worry out, customers will stop leaving. That's going to stem the bleeding. That's going to improve the performance immediately. And that really was a lot of it. So, we bought 7 banks to date. Yeah. I will, and it's a good question. I hadn't planned on mentioning it, but I will tell you all, you're coming out of this school, great resumes from what I've seen, great credentials. You're going to have lots of opportunities out there. The most important thing you've got to do in your career is never forget you only have one chance to blow your reputation and integrity. So Gene and I have had long careers. Gene's 67, I'm 56. I was 50 when I started this, he was 61. We've been in industry and public companies in front of analysts for a very long time. We have a lot of credibility. And most important thing, I remember sitting in front of the Ziff brothers, their family office. These are three brothers with $10 billion each, making a presentation, asking them for $100 million. And they kept telling us, are you crazy? We give you $100 million. You're going to buy a bank just to spend it. You just want to create an opportunity for yourself. Why would I trust you? And I remember stopping the presentation and saying, you know, let me be clear to you, I don't need a job. I can go get a job tomorrow. I've had 30 years in industry, and I've been well paid for 30 years. I don't need to do this just for the money. I'm not going to take your money and do something stupid to line my own pockets and blow my reputation. It's more important to me that. I started to go back to the presentation and said, stop, the presentation's over. We're giving you the money. So reputation matters. And now, having said that, that was a big part of it. A big part of it was there was opportunity. But a big part, I'll go back and say, there was too much opportunity. People were looking for a vehicle to stick money into. There were 10 national bank charters given out. And by the way, there's 7,500 banks in the country. There's 1,180 some odd national banks. In any typical year in the past, they might give out 40 or 50. In the last 5 years, they've given out 10. And out of those 10, 4 have already failed, and we've out-earned all the others combined. So and there were a lot of smart people that went out there. So we had a lot of luck. We did know what we were doing, but we had a lot of luck. Timing was good. A lot of things worked out for us. So the efficiency ratio, in order to make money in a bank, I'm going to make it sound simpler than it is just to make a point. I mean, there's a lot of factors that go into it, but you got to drive revenues and you got to manage expenses. And more banks struggle with the second part of that equation. Banks are largely people. It's hard. It's easier when you're looking at a plant and saying, I want to invest in that facility, I want to shut that one down and upgrade it. It's harder when you're talking to people and saying, wow, I need to cut costs. It means I need to fire the 4 of you. I've been working with you. I know you. So it's hard. It's just a hard emotional thing to do in industry. And what you saw was a lot of banks, they could see the crisis happening. If you read a lot of the books that have been written, they tend to be Wall Street centric. And people say, well, we didn't understand the derivatives and it took forever. We didn't know what was going to happen. And maybe that's true for Lehman Brothers, but it wasn't true for commercial banks. You could see what was happening a year in advance. And the people that thrived were the ones that took action early. A lot of banks that failed could have survived. They just couldn't bring themselves to say, we need to get rid of these 4 people to save the rest. So efficiency ratio is nothing more than what it costs you to generate the next dollar of revenue. 100 basis points historically is the average for a bank. It's not the average today is probably 75. So we were shooting for the average. We've actually outperformed most banks, but let's hope that's permanent, maybe temporary. In terms of the efficiency ratio, the average was 60. So all we were saying is we'll take these banks, we'll be disciplined about spending our money, we'll be able to get their performance up to an average performance. Now, we had just come out of 2 of the top performing banks in America. So everyone's heard of Bank of America. Fifth Third is a Midwest bank. I don't know, has anyone in here ever heard of Fifth Third? Okay, so it's a big company, but Midwest based. But the thing that it's noteworthy for is it used to be a cult stock. They used to outperform the industry in terms of the multiple 2 to 1. Had a 25 multiple for 8 or 9 years. And so, you know, when people were looking for a vehicle to invest money in, knowing that there was an opportunity coming and saying, here's a guy that, one guy that spent his entire career at B of A, this guy used to work for him there, had some big jobs, and then went and was a CFO of Fifth Third. So they, you know, people were willing to give us the benefit of the doubt that we could at least get to average performance. Okay. So we focused on urban markets. We ended up buying banks. So far, we like to describe our footprint as Raleigh in the Northwest, Nashville in the Northeast. We're in every market along I-40. That's the highway that connects that corridor down through most of the Carolinas. We've got to be bigger in Charleston. We have a single branch there. It's a booming city. We'd like to be bigger. And then we're down in South Florida from Miami, or sort of the Dade-Broward line, down through Miami, all the way to Key West. We've got a dominant share in the Keys, 25% market share. Doesn't amount to anything, but we do. And then up through Naples and Fort Myers on the West Coast. We'd like to be in Tampa, Jacksonville, and Atlanta. We haven't found the right opportunities there. We still have a lot of capital. Of that $1 billion we've generated, we've been profitable for a long time. We're generating capital, compounding the problem. We've got about $400 million of excess capital, so we're still looking for opportunities. It's a constant debate we have. I think it's more predictable that we'll be successful by building out scale in our existing markets, specifically in Miami. Miami is a massive banking market. There's not a lot of industry, and I think probably everyone here has their own perspective and experience in Miami, but tons of banks there. So we could be 10 times the size we are in Miami, and we're really underscaled in Miami. So partially the answer is that, but Tampa and Orlando are booming markets. Atlanta is an incredible market. The problem is there are lots of small banks in Atlanta. They're all actually too small. So we need something that's a little bit bigger to go into a market like that and be competitive. So it's really, what's the probability? Both of those things will work for us. What's the probability of success in the short term? And there was another question.
I was just going to ask, like, how much of that expanded
So, and from a branches, we've actually bought them all and then closed them. We haven't built it. Well, we built maybe one or two because we just had to. We bought some that were barely habitable. Is that a word? You could barely live in them. But for the most part, I think when we started, we had 175 branches. We're at 153. We closed some that just were poorly performing. Interestingly, you know, it's probably obvious to everyone in the room, branches are quickly becoming antiquated. So building a new branch, unless it's in a really hot market, it really doesn't make economic sense. So when I was at B of A, for example, we bought Fleet and combined and created a really impressive market share in New York City. But we were already building branches in New York City. And so we ended up, we started building out 10 branches. We bought Fleet and they already had 25, so we ended up with 35. Sometimes with branches on the same street, one block. But there's so much business in New York City that even our brand new branches would generate easily $100 million in deposits in their first year of operation. We don't have a single branch that has $100 million. So the market matters, but in general, I'm not a believer in building new branches. So, well, there's a customer shift happening that's just more a function of age than anything else. I mean, you're very comfortable doing a lot of business online, but your grandmother might not be. And so she's used to going to see Betty in the branch, and she's going to go there, and she's not interested in going online. And, you know, it's social for her to go in. And a lot of our branches, that's what it's like. You know, we differentiate because we actually bake cookies in our branch every morning and have coffee, and our customers come in for no other reason than come in for a cookie. So I'm a banker, and I have my own branches. I never go to the branch. So the future, I think there'll be a mix for some point in time, but I think it's not a good analogy, but, you know, you're too young to remember money orders, or traveler's checks. But there was a point in time when you would never fly to Europe without getting your American Express traveler's checks. I used to work for a company, the travel department there. It was, before you left, you went in and you got your traveler's checks because it was the only way you could spend money in Europe. And then one day you walked out of your hotel and you noticed an ATM there, and while you were waiting for your cab, you realized that has the same symbol as my card. I'm like, wait. So I walk over and use the ATM, and I would never consider using a traveler's check again. And of course, they still sell them, believe it or not. Every bank has a little drawer somewhere with some American Express traveler's checks for your grandmother or someone like that, but you know, they just don't exist. So I think as people get used to online, the convenience of online banking, by the way, B of A really invented online banking, had big advantage, and now every bank, we're about to change our online banking platform. It'll be better than B of A's. We'll just buy it off the shelf. They spent $2 billion developing it. I can buy it now for $200,000. So it's just a matter of time. This slide really has absolutely no purpose other than to brag. This is a thing of beauty. If you want to start a company and you're a CFO, this is what it doesn't matter what it says. Just going up to the right is always good. Special assets in banks, when you buy failing banks and you got a lot of bad loans, for some reason they call them special assets. We bought 7 banks. We had a lot of special assets. We peaked at over $1 billion. We're now at $300 million. And yes. You know, we're not. We've had a lot of success in the company. I'll show you another slide in a minute, just to brag. But we still, because we have so much excess capital, this is a simple thing you guys all do in your sleep. You can earn a lot on your assets, but if you got too much equity, that means your ROE is going to be depressed, and ours is. We've got the norm for our industry is about 8% equity. We're at 13.6. What does that mean? We're out earning the industry in terms of absolute return on the number of assets we have. Too much equity means our equity is 7%. Got to be double digit. So our stock, although it is performing very well, it still doesn't have the best multiple. So, sorry. Yes. The real answer is probably one of the 3 primary things you do in your job. In my job today, we have too much capital, so we've been, I wouldn't say we've been sloppy in capital allocation. I'd say we've had to put money and allocate capital to things I normally wouldn't. So we have a lot of thinly priced assets on our balance sheet that I normally wouldn't buy, but because I have so much capital, I've got to generate some return on them. So the answer is I don't spend as much time on what you mean by capital allocation, trying to make the tough decision between 2 alternatives. I tend to say I got enough capital, I'll do both, or all 3. Is that? Yeah, our exit strategy is to sell the bank because it's just, you can't fight the trend. There's 7,500 banks. At lunch we were talking about that. You think of 7,500 banks as 7,500 factories that produce the exact same product. It doesn't make any sense whatsoever. Doesn't matter what the product is. It's just exchanging money. It's a pure commodity. You got 7,500 back offices, completely redundant. Doesn't mean there has to be one, but there's no reason to be 7,500. There used to be 12,000 banks in the country. There's now 7,500. I don't know if the right answer is 3,000 or 4,000 or 2,000, but it's not 7,500. So our exit strategy is to get the bank to a average multiple or better. Remember, our commitment to our shareholders was average performance. Our goal was obviously to do better than average. And that's one thing you all, I'm sure, know by now, that one of the things you have to, it's got to be a mantra, under promise and over deliver every day, every year, if you want to move ahead in your careers. So we committed to average performance. We thought we'd get an average multiple. We'll sell at a premium multiple. And I don't know if that's a year or 2 years or 5 years, but as soon as the stock stops appreciating, and to us that would say somebody else will offer us a premium and our shareholders will benefit, and we've got to do what's right for our shareholders. It has been, unfortunately for us, yes. The question, if you didn't hear it, was, since we're having trouble finding assets, is it all about repurchasing stock? And we have been. We repurchased 2 million shares, $60 million worth of our own shares last quarter, which is a lot. We've repurchased 20% of our company since we went public because the stock was lagging and we knew it was going to be worth more. The problem with buying back stock is we're still it's sort of a blessing and a curse. We raised our money from a concentrated group of about 35 investors. We have no float. They love us, so they don't want to sell anything. Our average float is about 125,000 shares, and what you're able to buy, we have a 10b5-1 program, and you're allowed to buy 25% of your float, but it doesn't amount to that much. So we have been active buyers, and we're always out asking our shareholders if they, you want to sell, please call us. Last quarter, we were able to, somebody needed some liquidity, and we bought back an extra 1 million shares. Somebody at lunch asked a question about what's the next area of risk for banks. And this is an interesting slide that we use with analysts all the time, because we're about to begin, I think, I've been wrong for 3 years, but I think we're about to begin the next rate cycle. And I know absolutely nothing more than anybody in this room, because everyone's got an opinion. There is no one on Wall Street there's no consensus anywhere. So we don't know. I think the odds are, if you look at the futures market, the swap curves, you'd say the Fed is going to raise in December. But the question is that the beginning of 25 basis points every meeting, or is it 25 and 25 at some point? And so no one really knows what that is, but we know eventually rates have to rise, and when they rise, the primary measurement of how you're positioned is your asset or liability sensitivity. Just means nothing more than, are you going to benefit when rates go up, or are you going to suffer? Hang on, let me finish that. There's a question back there. I apologize. My hearing is not the best. I wish I could say that. The honest answer is no. Honest answer is no. So I wanted to be positioned to be neutral for rates. I think that's the right way for a bank our size. A bank like B of A, they actively trade their portfolio. They got a lot of sophisticated people that do it. They can make a lot of money at it. We don't have that. So our position was be neutral. Don't try to take any bets. Our customers drove this. I'm going to come back to this in 1 second. All right, so make sure I do. But let me just explain what we have here on the chart. So I told you I was at 2 conferences in the last 2 weeks. I've met with there were at least 200 banks there. And at every conference, because of the rate environment, there's always a polling question, who's asset sensitive? And everybody raises their hand, everybody, because nobody wants to look like a fool, right? The rates are about to rise, and if you're liability sensitive, there's immediate selling your stock. So everyone says they're asset sensitive because in the first 12 months, virtually every bank is asset sensitive. Your loans reprice generally on LIBOR, 30, 90-day LIBOR, all commercial loans. And so you get the benefit very quickly. Your deposits reprice whenever you feel the competitive pressure. And so first 12 months, everyone's happy. But over time, your deposits reprice to a greater extent. And that's when EVE, or economic value of equity, becomes the critical measure. And so all this says is, this is how we're positioned in the dark blue bar. The gray bar is the median bank. And this is straight from the OCC. The OCC regulates national banks, so the biggest banks. And so because they're concerned about how banks are positioned, they went out and asked all banks, all national banks, to share all the assumptions in their ALCO models with the OCC. And the OCC, first time they ever did it, fed it back to everybody and said, this is what the median bank does. And what does that say? Forget about the first 12 months on the left-hand side when everyone's happy. We're happier than everyone else because they're going to make 2%, we're going to make 6 or 9%, although these parallel rate shocks are never going to happen. It's just a theoretical exercise. But we're better positioned than the average bank. On an EVE basis, though, what does it say? It says the median bank's actually liability sensitive, really liability sensitive. And what does that mean? It means there's risk there. Somebody's going to be hurting. So there's 2 ways to get your stock to trade at 2 times tangible book. One is quickly raise your earnings and keep your equity, right? The other is to let your tangible book get cut because your economic value falls apart, and we'd rather get there the first way. So right. So net income, that's just GAAP net income, right, for 1 year. EVE is the lifetime value of every asset you have on your balance sheet. Most banks hold about 15 to 20% of their assets in securities. And one of the peculiarities of bank accounting is you don't have to mark those to market. They do flow through equity, but they don't flow through your balance sheet, through your income statement. Excuse me. But EVE says, well, mark them. Mark them. So if I've got a 30-year bond on my balance sheet that I bought with a 2% yield, and rates start going up, what happens when that happens? What happens to the value of that bond? It goes down. I don't have to show that in my income statement, but I got to show it in terms of EVE. And so what this says, this is really a comprehensive look at the health of the bank, the value of the bank. Okay? So we're in good shape. Yes, it means we're heavily asset sensitive, but what it means beyond that is we're really short. So what is asset sensitive? How do you really get to be asset sensitive? You say your liabilities are shorter than your assets. So we got I'm sorry, the other way around. Our loan book is shorter than our deposits. Thank you. I told you I wasn't a good student. So that's, if you think of our loan book is actually traditional 5-year commercial loans, right? So if you got a 5-year commercial loan book, just say half of them are, the average life is 2.5 years, right? That's pretty short. So if rates go up, it's not going to hurt you too bad. But what's happened in the last rate cycle is yields have fallen so low that banks have extended their loan book. They've extended their duration risk. And what does that mean? That's fine. It gets you better yield in the short term, but eventually rates rise and you get nailed. Okay. All right, that's in the wrong spot. All right, thing of beauty. Here's our stock price. We went public in September of 2012. This just shows you how we performed. The S&P is up 35%. If you've been in equities in that time, you've done very, very well. If you've been in capital bank stock, you've done twice as well. So what does that mean? We bought those banks. They weren't performing well. We've improved their performance. You see us outperform the index, but right now we're trading about 1.75 times tangible book. The norm is 2. We're about at the average for our peer group, but we're out earning our peer group. So our multiple isn't really fully reflecting the value of our earnings yet. Part of it is we're still new. We're still telling our story. Hopefully that'll catch up. Our asset sensitivity? Yeah, exactly. Our earnings have suffered recently. That was a great comment, that being asset sensitive is great when rates rise. It's not great when rates are flat, as they have been. We've been giving up earnings. And I think the question in the back that I skipped over was we positioned ourselves this way. In reality, we didn't position ourselves. Interestingly, every year we were expecting rates to go up. And the phenomena I could not understand is our customers kept demanding variable rate loans. That doesn't make any sense. When rates are going to go up, you're going to lock in your borrowing. But 70% of our commercial customers were choosing variable rate loans, and we weren't putting on any swaps to synthetically fix those loans. So we were becoming more and more asset sensitive. And every quarter I'd say, what is wrong with these people? Don't they realize rates are going up? Well, guess what? They were smart and I wasn't. And so last quarter, the first quarter that we've had since we started, where our customers, 53% wanted fixed rate loans, 47 variable. So the customers are a lot smarter than I sometimes give them credit for. All right, let me go backwards for a second, just to give you an idea of my experience. I left Florida. I spent my junior summer as a intern at a company called Litton in Florida. And actually, I'll go way back, just to give you an appreciation of how much this school means to me. Because I showed up here again, I had $80 in my pocket. And I was raised by a single mother. She passed away when I was 17. I ended up knowing I had to go to college. I had no one guiding me. Fortunately, all my friends were applying to Florida. I ended up applying late. Didn't have great grades. Somehow, miraculously, I got in. I showed up here with $80. I had no idea how I was going to pay my tuition. Somehow, I worked it out. I figured out a way to do it. I got a great education. In my junior year, I had an internship in California with an aerospace company, and I didn't really like it. I mean, I got paid well. I needed a job. It was the only job I had offered. I came back and I went through my senior year, and the economy was terrible. The Dow was at 800. The prime rate was at 18. Nobody was hiring bankers, and I was a finance major, and I didn't have any prospects. And I had a job offer from Litton to go back to work there. I told all my friends, I got to take the job. I'll go for 6 months. I'll be back. And I ended up going from Litton to Teledyne. Those two companies were a mile apart and were formed by the same group of guys. And then TRW, all of which are all combined into Northrop today. So I worked for all three companies. It was during a time of rapid change in the aerospace industry, going back to when Reagan was president, and there was the Cold War with the Soviet Union. He was spending tens, if not hundreds of billions of dollars on an arms race, and there was massive change. And I just happened to be at a place purely by accident, by necessity, and I saw lots of opportunity. And so I just took advantage of the opportunity. Wherever I could see something was going to change, I tried to position myself there. And I encourage you guys to think about in your own career plans are you going to a place that is going to be changed, and how are you going to try to take advantage of it? So I went through there. I had a lot of fortunate things. I went back to business school. I ended up, when eventually the bubble burst in technology spending, this is all government-sponsored technology spending. When that stopped, I decided to start an internet company with, I had a business school professor, my economics professor, who I'd become very close friends with. He called me one day and said he had a consulting engagement for a healthcare company that was about to go into bankruptcy. Could I give him some time to just help think through an angle, if there's any angle to save it? And the company I'd worked for at TRW was the commercial program manager for DARPA. DARPA is the defense agency that does a lot of cutting edge technology, and they created DARPANet, which became the internet. And so we had a lot of guys there that knew internet, and it was just kind of a buzzword at that time. Nobody really knew what it meant. But I had somebody show me what the internet was. I was so curious. You know, I asked an engineer one day, and he came in and he showed me how it worked. HTML was, still a buzzword. Netscape didn't exist. There was a program called Mosaic that was being developed by a bunch of students at University of Chicago. Mark Andreessen. Anybody heard of Mark Andreessen? He was 19 then. So I got a beta version of Mosaic on my desk. I had a fancy computer on my desk. Somebody came in on a Saturday. I spent the entire day. I was so fascinated. I spent the whole Saturday there. And because I never really used my computer, but I had to have one because it was a status symbol in those days to have a nice new PC. But I had the screen over here. I spent the whole day like that. And on Sunday, I literally could not move my neck. There's been 10 hours in my office. And I knew right away, this is going to change the world. So I started a company, quickly decided, all right, this little healthcare company, its problem was it was a closed architecture technology program. They didn't have enough money to improve it, and we thought, all right, we can quickly port it onto HTML. To believe it or not, after one Saturday, I said, I know how to program in HTML. It was that simple. It really was that simple. So we went out, we raised some money, we went to a bunch of people and did a private placement, did 3 private placements, and we would just say healthcare, internet, people would say, we're in. It was the timing was great. We started the company, it did very well, it was profitable from day one. Back before you didn't have to be profitable. We were raising money, and we were funding ourselves as we were going. And then Jim Clark, who was the founder of Silicon Graphics, and then the founder of Netscape, announced his third act was going to be he was going to create WebMD. It was our direct competitor. And overnight, we went from raising whatever amount of money we needed to we couldn't raise $1. And so we quickly sold our company for whatever we could get. And for me, it was a lot, but it wasn't, believe me, it was the day when valuations were not, there was no bubble at that point. But I was just glad to get out. I got recruited to go to Allied Signal. And if no one's ever heard of Larry Bossidy, buy his book, Execution. It's on the bestseller list for 3 years. Larry Bossidy was the smartest businessman I've ever met. He'd been the vice chairman of GE, he spent 34 years there. He created the modern GE Capital that's now being unwound. Jack Welch's best friend. And he decided to come be CEO of Allied Signal, which was a sleepy little industrial conglomerate. And the first thing he decided to do was to replace the entire finance chain in the company. He just said, I'm going to get rid of 52 companies, I'm going to hire 52 CFOs. I was just lucky to get the job, to get called, to go to one that was quasi-government, technology. My background sort of fit. I wasn't a CFO, but I got the job. And I did a good job there. And I moved up through Allied Signal. We bought Honeywell. I got picked to be on the integration team. The 2 companies had a job managing a bunch of global teams around the world. And then Bossidy retired. He handed off the reins to Mike Bonsignori, who was the CEO of Honeywell. And after 8 years, where our stock went up 800%, we missed our earnings by 1 penny for the first time in 32 quarters, and the stock lost 35%. and within 45 days, the company was being sold to GE. It was that quick. So I started looking around for something to do. We were we were waiting for merger approval. The deal never got approved, by the way. But I was looking for a new job. I got a call from a headhunter at Russell Reynolds, and he said, look, I'm having trouble finding a candidate for a job at Bank of America. You're not the right guy. This isn't the right job for you. But if you would please go down and go to an interview, I'd really appreciate it. I'll help you at some other point. I flew down to Charlotte. I had no expectation, just doing someone a favor. I went in to meet with the CFO. He waved me over to a table and said, I'll be with you in a minute, and don't get your hopes up, because you're the first guy I've seen, and we're not going to make a decision for months. And in an instant, I said, I'd never work for this guy under any circumstances, ever. And I interviewed with him, talked to a few other people. End of the day, I came back, and he said, okay, we're going to hire you. I said, guess what? I'm not interested. He said, no, we're going to hire you. And I said, look, I appreciate it, but I got a plane to catch. He said, it's Bank of America. Nobody ever turns us down because of money. I said, okay. I'd love to tell you all it didn't matter to me, but it did. And I ended up going to work for B of A. That guy is Mark Oken. It turned out when we started Capital Bank, he was one of our first investors. He now runs a private equity firm and sits on our board. I was at B of A. I went through a series of the deal I had there was B of A had just recently bought, Nations Bank had recently bought Bank of America. They were now not just a national bank, but they were also a full-service money center bank with an investment bank. They had bought Robbie Stevens. They had no idea how to get their systems to talk together. They didn't understand how much money they were spending on technology. They looked at my resume and said, wow, you have a lot of technology. Yeah, it started an internet company. It was this big, and it went out of business, but it didn't matter. They said, you must know a lot about this. And I said, yeah, I know tons. Somebody asked me today about the different jobs. I promise you, every job I've had on here, I was unqualified for. Very unqualified, but I was willing to sell myself. I had enough confidence I could learn it. And that's an important lesson, I think, for everybody. So I got in there and I said, I'll take the job on one condition. I want to be in the main line of the bank. The job was being their CFO for all their technology-related businesses, including their in-house technology group, had a $7 billion budget. They didn't know if 7 was too high or too low. Kid you not. And they said, we're going to give you a goal to cut $700 million out. I went in and did some analysis and realized it wasn't even $7 billion. Taking 700 was just doing the math right. And the 700 came right out. It's how bad the bank was at that point in time. I spent 6 years there, and during that time, B of A came into its own. The stock was up by 150%. I told the story before that up to that point, Bank of America had been buying. Someone asked about organic or acquisition, what's better? B of A had done nothing, and previously Nations Bank had done nothing but buy banks. They bought them, they put them together, they lost a lot of customers, they didn't care. They said, we couldn't care less, good luck to you, we're going to buy another one, don't worry about it. Then we got to a point where we exceeded the 10% deposit cap, which is a law, and you can't have more than that in the country, and if you do, you can't buy anybody. So for the first time, the company decided we need to have some organic growth. We need to figure this out. At the time, I was the CFO of the consumer bank, biggest consumer bank in the country. And my boss said, guess what? Put together a strategy so that we have 500,000 net new checking account customers this year. Okay, let me go look at the history. And I looked and said, we've never had any net new checking, ever. And he did the most brilliant thing. To get everyone on the same page, he said, everybody in the company, and banking is a bonus-driven business, right? More and more and more of your compensation comes from your annual bonus. And he just said, everyone in the consumer business, at the time, 150,000 people, nobody will get a bonus if we don't hit 500,000 net new checking accounts. And that got everyone's attention. And immediately, the power of that big company came together, and we did dozens and dozens of things. And what I said earlier, we just picked the things that worked. Lots of them didn't. But at the end of the year, believe me, through sheer force we closed the books with 502,000 net new checking accounts. And I went in with the results as we closed the books. I went in to show him, okay, we did it. We high-fived each other, and he said, okay. He sat down and typed out an email and said, congratulations, everyone. This year's goal is $1 million. And we did 1.2 million. And then we started developing a process. What was important? We started testing, doing the things that you've gone to school to analyze. And we did a lot of marketing research and figured out what customers really want, how to cross-sell customers, what was really important, how do you price products. The bank had never done that before. We developed what's known now in the industry as the area of indifference. If you're a Bank of America and you're a capital bank and I pay you 70 basis points on your money market account, B of A knows I can charge you 52 and you don't care. That's the area of indifference. I'm not going to, they were sophisticated enough to do those things. And B of A turned out, it was the company was just incredible. Our crowning glory was the quarter when we earned in one quarter $22 billion, more than net income after tax, $22 billion, more than GE. The company changed. I was sitting on a beach one day in Naples. I got a phone call. The cell phone was ringing. It was a guy named George Schaefer, who was the CEO of Fifth Third Bank. And he said, hey, I need a new CFO. And I've got a guy here that used to work for you. He says, I've got to interview you. I said, Fifth Third Bank? It's in the Midwest. I have no interest. And he said, why don't you come meet with me this week? And I said, I can't do it. I'm on vacation with my family. Thrilled to hear from you. And he said, well, I actually know your vacation's over on Thursday. Your secretary told me you got Friday off. Why don't you fly up and have lunch with me on Friday? I flew up to meet with him, and within the day, the afternoon, I had an hour scheduled. Then he took me to lunch, and then he decided to drive me home to meet his wife at his house, and then drive me to the airport. And by the time I left, I knew I was going to go to work for him. And his pitch to me was, you've got an incredible career at B of A, but you're never going to be the CEO of B of A. You're probably never going to be the CFO of B of A because you've just joined the company. You're from outside. Everyone there, it's an insular culture. You're eventually going to get squeezed out. And don't you have any confidence and any ambition? Right? He was 63, and he said, I'm going to retire in 2 years. Don't you want to even have a chance? I don't think you'll get the job, but at least you have a chance. And I said, okay, I'm in. So I showed up, Cincinnati, was living in a hotel across the street, and 6 weeks after I got there, George had his third heart attack, and he did come back to work for about a month and said he was retiring, and I realized my opportunity timing was against me. So I ended up working for another guy. We did not see eye to eye. If I wasn't a petty person, I would tell you that when I left there, the stock was at $22. He just retired, by the way, and the stock is still at $22. You do remember my chart. I went to Blackstone, as I said. As I was at Blackstone, we had an engagement to go in and meet with another friend of mine, had also been the CFO of B of A, who had taken over GMAC, now Ally Bank. And Ally was headed towards bankruptcy. And this Al Di Molina, he asked me to come in and be his chief. He actually asked me to come in and be his CFO, and I didn't want to do it because I thought the company was going to fail. He said, come in and be the chief restructuring officer through Ally. I eventually just went there. I spent 6 months, put together a restructuring plan, began to implement it. In fact, we had our first profitable quarter. And then Al got fired. And I followed him right out the door. And that's when we started Capital Bank. So that's my background. All right, I'm going to go backwards for a minute because, that was the first time I'd IPO'd a company, and I said at lunch, I told all our investors, yeah, I know exactly what to do. I didn't. The reality is, there aren't many people that go through more than one IPO. The challenge with our IPO was the economy was in terrible shape. We actually went out, we had a date to launch, and it was the date, the same week that Facebook was going to launch their IPO, and it was a disaster. And the market shut down overnight. So we delayed it, we went out, and it was really not a good experience, quite honestly. Everybody thinks, the IPO is you go out, you're the toast of the town, you raise a bunch of money, you go ring the bell, and everyone's drinking champagne. Ours was not like that. It was tough. The reason we did it when we did it is when we raised our money initially. Did somebody leave us up here? When we raised our money initially, we promised our investors we'd give them a liquidity event within a couple of years. And so we could have asked for an extension, but we felt we had to live up to that commitment. So it was brutal. I'm glad I did it. I'm really glad I have had the experience. I will tell you, and I tell everyone that I know going through it, going through an IPO is tough. It's like running a marathon and you're not prepared for it. It takes 9 months from start to finish, and it ends with a couple of week sprint, and it's really a draining experience. But it's it's part of, if you want to have a public company, it's the only way to get there. I did a lot of things wrong, which I won't talk about because it'd take up the rest of our time here together. But we're public. So the economy and the job market, real quick. When I look at banks, we're trying to figure out what's happening with the economy, what's going to happen with rates, and as I said, I've been wrong. We do spend a lot of time. We got a lot of people on our team that do a lot more study around this, but I just tend to look at some simple things. So what do you see here on the left-hand side? You see hires, job openings, and quits, and the only thing noteworthy is the blue bar at the top. Those that say job openings are outpacing hirings, it means there's more demand. You can see in the last few weeks it's really starting to pick up. And you can feel it when you're out loaning money to customers that things are really gaining momentum. It's been sort of stop and start for the last year or two, but I think we've now broken free a little bit. But on the right-hand side, which is the thing you're constantly reading about, is unemployment's down, but in terms of labor force participation, it's a terrible story. And nobody really understands why that is. People really, you read about it in the paper that people are just giving up and now you've got permanently unemployed people. Is it really that? Is it the aging? Is it demographics? Is people reaching retirement age earlier? We don't really know. And that's why, there's 1,000 other metrics that the Fed looks at, but just these two alone, you just look at them and you say, wow, two totally different stories, just looking at one little tiny slice of the economy. Well, somehow I had this chart out of order. Let me see if I can catch up now. Okay, so I'm going to go backwards. I apologize. I guess Lauren's right. I don't know how to use this technology. So what happens when interest rates rise? Even in the first year, what happens to bank stocks? They do great, right? First 12 months, even though we all just saw that EVE, the median bank, is actually going to suffer, spreads widen, margins widen. And as a result of that, earnings get better, multiples expand. And so what you see here is what happens. This is just a correlation of the KBW index, which is just a regional bank index. There's probably 10 of them, but this is the one that most people look at. You compare how that performs versus interest rates, and this is a reasonable period of time, but I think it may not look it to you, but to me it's a very tightly correlated relationship. And now what you see in the most recent period is anticipation. People are starting to bet rates are finally going to rise, and what's happening in the last 6 months, you've seen bank stocks be on fire. Ours are outperforming most, but in general, the industry is doing very, very well. Yeah, it's hard to isolate any one year and say what happened in that one year as opposed to looking at the pattern in total. So yeah, it's probably 2007 was the beginning of the recession. We knew the Fed anticipation, the Fed was going to have to cut rates. And what does that mean? Bank stocks are going to suffer. And so that's, in looking back, that's the logical answer. But yeah, I don't really know in 2007. I know right now it's anticipation. I spend half my week with investors, and everyone's trying to, the way they'll say is it's the risk on, risk off trade. Right now it's the rate on, rate off trade. And so people are betting right now, they're trying to pick who are the banks that are going to benefit best. All right. Sorry about this. All right. I said I'd mentioned the path to CFO. I don't know the right path, but I'll just tell you, just from my perspective, what are the key jobs? In my mind, the most critical job for any CFO is their planning department. And it's not a job that most people really think about. When you read a textbook, you tend to think about the controller and the accounting department. And I know this university has one of the best accounting programs. Is anyone planning on being a CPA? Good, okay. I hate accounting. I mean, it's so boring. I can't imagine being I've got a chief accounting officer and a controller. They're outstanding, and I just thank God I have them because I can't, that's not me. On my team, what do I manage? I manage accounting. Tech and ops is the back office of a bank. So I have a job which is sort of CFO and chief operating officer of the company. So I have tech and ops, HR, and a few other things that aren't on here that are not really related to finance. But in finance, accounting, tax, and by the way, in accounting, the only way you're going to succeed in accounting, you got to be a CPA. Right? There's no other way. In tax, you got to decide you're going to be a subject matter expert, and that's your life. And there are some people, I mean, I've met some incredible tax professionals. It can be extremely lucrative, but that's your life. Treasury, you got to know capital markets. I was thrilled to see the resumes of the folks I had lunch with today. I think everyone was Bloomberg certified. Let me tell you, if you're not, when you get out of here, you got to know Excel cold. And I know you all say, oh, I do. So does everyone else you're going to work next to and compete with. So you got to know it better than everyone. You got to know it better than anyone. Same with Bloomberg. Get certified. Don't just check the box, but go in and use the fact that you've got a lab up here. That's incredible. Make a habit of going in there every couple of days and using it. Make sure you understand how to do it. It'll separate you from your competition. So treasury in a bank, that's the guy who actually manages our investment portfolio, trades the bonds that make it up, does our capital allocation. What do you need to do there? You need to have really good analytical skills. You got to know the capital markets. In order to be the treasurer of a bank, you got to have an innate feel for how bonds trade, how they're going to trade. A lot of experience. Everybody always says they want to be in M&A. Actually, it's probably the worst way to get the path to being the CFO because M&A is generally a long cycle event. Banks, we buy a lot of businesses because we're unusual and start up with a lot of cash. Most companies, it's episodic. You may be the guy who does a lot of research and you bring in the information to the CFO and he loves you, but it may be every 3 years that they actually think about doing a deal. So I'd be careful about thinking about spending too much time in that function. And then there's planning. Planning is typically, in most corporations, the group that puts together the budget, analyzes all the business units, does all the, I mean, it really is the analysis part of the CFO. That's the person I turn to 2, 3, 4 times a day to answer questions. And whether it was at TRW, whether it was at Allied Signal, whether it was at B of A or even in my business now, that tends to be the place. If it's not a path to CFO, it's a path to great opportunities because you're that's the team that is constantly interacting with the senior executives in the company. Every time someone wants something to do, they've done or answered, they turn to the planning group. So not a long message on this chart unless anybody has a question. By the way, is there anyone, I know virtually everybody in here wants to be an investment banker, but is anyone planning to go the corporate route? What is your plan? Excellent. Great company. Where are you going to be, in New Jersey? Oh, Jacksonville. Okay. Well, if you do a good job, you're going to be in New Jersey. Okay. I actually thought that I was going to talk a little bit about the change in banking and get you all excited about being a commercial banker. Your 4 teammates who had lunch with me quickly dissuaded me of that idea. And actually, I think if I were in your shoes, I would absolutely want to think of investment banking as a primary alternative. But what I want to talk a little bit about, and this chart doesn't really address it, but I will point it out. Compensation is just one factor. But I will tell you that as a result of the changes that started back when Glass-Steagall was passed, it's been one major factor that has caused a continual change in the business model for investment banks. And they continue to change, and they will continue to change. And that doesn't mean they're better or worse. It just means knowing they're changing, think out a little bit and try to position yourself so you can take advantage of that. Yes. I'm 99, I'm sorry. Interstate banking passed in 95. That's right, 99. Give that man a gold star. So 99, and you think about that, it's only 16 years ago. And what's happened since then? B of A bought Merrill Lynch. Citigroup is now got a massive investment bank. Wells Fargo's taken the longer path towards getting there, but I wouldn't put it out of the realm of probability that when a reasonable sized boutique like an Evercore, if they become available, or a Centerview, that they don't snatch it up to try to build some scale. It's almost impossible to run a commercial bank, especially a large commercial bank, and not have the prestige of an investment bank. So what happened? Goldman Sachs, Morgan Stanley, those are the firms who ruled the day. And those were firms that were really run on the basis of relationships. You were either a house accountant at Goldman Sachs or to Morgan Stanley or somebody else, but those are the biggest, those are the best. And when you needed advice on a deal, you went to those guys, you paid whatever they asked, you didn't really question it. And a couple of things happened. One is Glass-Steagall passed, and suddenly B of A bought Robbie Stevens, Citigroup, I forget who they bought, but they started bulking up in investment banking because they knew I can come in, Goldman may have a better brand, but they can just give you advice. I'm going to come in and give you advice, and by the way, I'm going to undercut them and charge you less. But I've got a balance sheet. So you want advice on how to do the deal? That's fine. If you want my balance sheet, you got to use my advisor. And so suddenly, that didn't put Goldman Sachs out of business, obviously, but it changed the dynamics enough. And so what happened? Goldman Sachs started to see competition on the advisory side. I'm just using them as an example. And they're an incredible firm. I've used them many times. I have a lot of friends that work there. But they started having competition, and in order to make up for the initially small cut in their revenue, but they could see out into the future, they started expanded trading. Well, the firm was financed through partner capital. They couldn't have a massive trading platform funded purely out of their own partners' pocketbooks. So they decided they'd go public. Let's get big amounts of permanent capital. And that changed the game, because suddenly the private partnership, you can have a good quarter, offset a bad quarter, and it's just, you know, as long as you end up at the end of the year ahead, it's fine. When you're a public company, you can't do that. So change the dynamics. Now you look at Goldman Sachs today, look at Morgan Stanley today, right? The firm was always run by a guy who came up through the advisory side. That was just all, it was always advisory. The trading was a tiny little piece. Now what do you have? Goldman Sachs is run by a trader. Morgan Stanley is run by an asset manager. And they'll probably never go back, ever. There's a lot of rumors that, well, maybe they'll switch back. And, you know, they've kind of alternated. That's not true. What else happened? Goldman Sachs went public. Virtually every partner, every senior partner left. They took their money, and where'd they go? They went to private equity. 1995, private equity existed, but you know, the firms that dominate today didn't exist, right? Blackstone, Steve Schwarzman was at Lehman Brothers. And I guess KKR was around, but there wasn't much there. What's happened in the last 20 years is, in terms of compensation, it's been rationalized. Now, that's not just the last 20 years because of the structural changes. Obviously, the financial crisis hit everyone. Compensation had to get cut at all the big banks. But what you've seen is, you know, compensation drop among the investment banks, but just skyrocket at private equity. So the truly elite bankers, more and more frequently, when they have an opportunity, they go to private equity. That doesn't mean investment banking is dead. It's never going to be dead. But now what you see is sort of the advisory stuff getting pushed out of the big banks. A lot of people don't go to Goldman anymore because they've been burned. I personally have. I've hired them, paid them a massive fee, tens of millions of dollars, to restructure hundreds of billions of dollars of securities portfolio, only to find out they were on the other side of the train. It's like, I'd never use them again. I still like them, good guys, but I'm not comfortable with that. So what happens? A lot of guys have moved their business over to the more boutique firms. So people like Evercore, Centerview, and there's 20 others like that. So lots of change happening. That doesn't mean there's anything bad. It just means try to think out, how's that going to play out in the long term? And how's that going to affect you? And how are you going to get an opportunity out of that? That's right. I won't bother with the rest of this. I will note, investment banking, senior level job, MD at an investment bank, senior vice president at a commercial bank. Comp is about equivalent. The only difference is if it's comp driven, there's at least 9 times the jobs at commercial banks than there are investment banks, just fewer of them. I won't even bother with this. You guys all know this. Most of you have had work experience here, I think. Show of hands. Who's already had some? All right, so you know, you're going out though your first year. We all know. First year, no work-life balance. Don't even pretend to. Everyone's HR department wants to stress how it's your responsibility to maintain your own. It doesn't exist. All right, Excel excellence or else, that's too trite. I will say, I told someone a story at lunch. I have a great friend that worked for me at B of A, wanted to be an investment banker. I got him a job in the analyst program. He left and went to UBS. I really wanted his next job at Goldman. There was a job open. They called me for a reference. He's the best guy. You got to hire him. They loved him. They interviewed him. He came back, and they finally said they turned him down. Why? His Excel modeling skills weren't good enough. I said, Excel? You've got to be kidding me. Excel. Everybody in here thinks they know Excel well. But again, you're in a very competitive school. Everybody, you look around, everyone in this room is smart. It's been competitive. You're going to go to work, and you're going to go to an elite firm, an elite industry, and everyone is going to be elite. And it doesn't do you any good to say, well, I'm going to just be as good as the next guy. You want to outcompete them. So they're all going to come with great skills. Excel is just one of them. Bloomberg's another. But man, I'd say really push yourself there. Test yourself. Don't do what's required to get through your classwork. Figure out how good am I really? Read everything. That's not what's on the test. Wherever you're going to work, if it's Evercore, where is Casey and the other guys that I had lunch with? All right, if you want to be prepared for Evercore, I go read everything you can about the firm, and there's going to be 10,000 pages of data out there. I know everything Robert Altman's done in his whole career. I know every partner's bio. You couldn't do that when I was in school. You couldn't. I'd read every financial filing for the last few years. I'd understand how the firm makes money. I'd read all the analyst reports, every single one of them. So when you show up, you're informed, because you may get a chance to be on an elevator with Mr. Altman, and you want to be able to ask him something about himself. You want to, that's not required, but that's just a tiny little thing that everyone here should be prepared to do and should be doing already. I talked about your integrity, getting noticed, always be more prepared. It's all redundant at this point. But I will say one thing. How many people in this room want to go into sales in their career? I love it. Okay. How many want to go into investment banking? Okay, there's not a single one of you who'll be successful if you're not a good salesperson. I'm dead serious. But the only way you'll ever get to be an MD is you're so good in front of the customer, you can sell the next opportunity. That's everybody knows how to use Excel by that time. Everyone knows how to do research. The dividing line is who's good in front of a customer. It's not about the advice. It's not about, being smarter. Everyone's going to be smart. You've got to be a salesperson. Anything on here? Okay. I'm not going to. All right. This is my last slide. So I was in business school, and we had to show up on a Saturday for an all-day workshop, and they wouldn't tell us what it was. And they just said, come prepared to spend the whole day. It's going to be a thought-provoking exercise. And we sat down, and our professor, who wasn't my favorite to begin with, said, okay, we're going to sit here today. Everyone had a pad and a pencil. He said, I want you to write down what you want to do. This is going to be, we're going to put together a career plan. Now, if I ask all of you what you want to do, everyone's got an answer, and you have 100% conviction that's what you want to do. But if I ask you right now, Casey, what do you want your job title to be in 30 years? Sure about that? What firm do you want to be at? Where do you want to live? That's good. Not to put you on the spot, sorry about that, but he asked us the question, and he said, I want you to write some of these things down. And then he said, and we all started scribbling, and he said, take your time, because you're all going to stand up and explain to people why that's what you want to do. And everyone tore up that page, started writing again, and tore that up, and then started thinking. And I sat there thinking, what do I want to do in 30 years? I don't have a clue. I'm not sure what I want to do in 2 years. I know what I want to do now, right now, the next job I want. But what do I want to do in 30 years? How much money do I want to make in 30 years? I don't know. I'm not even sure. Do I want to be married? I wasn't married at the time. Do I want to have kids? How many? And what he was forcing us to do was to really crystallize in our mind, what do we want to accomplish in our life? What do we really, really want? What was our priority? And then think, where are we now? Now let's be realistic. What's the path to get there? Now that seems obvious, right? You wouldn't say, hey, I'm going on vacation. I'm not sure where I'm going, but I'm going to get in my car and start driving until I get there. Everybody knows you need a roadmap in life. But very few people really think out into the long term. Now, I've recruited hundreds and hundreds of people to come to work for our companies over my long career. And I've mentored hundreds of people, and I can't tell you how many times I ask people what they want to do, what's their career goal, and they're like, I'm not sure. And this is a big differentiator. So when I did this exercise, as I showed you before, I was getting an MBA, I was at TRW. I was the youngest executive. It doesn't matter what the title was, but I got to a certain level in the company. It was a 103-year-old company, and I was the youngest executive in history to get to that level. was 29, and no one had ever done that before. The original chairman of the company when I was there, he'd since retired, had done it at 35. I was there at 29. People were saying, my God, you have an incredible career ahead of you. I sat in this exercise, and I would have always told you I want to be CEO of the company. I was 29, I'm the fastest growing guy, and then I realized this is an aerospace company. I was never going to be CEO of that company unless I went back and became a PhD in engineering. But until I sat down and forced myself to write down, this is what I want, was I willing to do the things needed to get there, that I forced myself to say, no, I'm not. I'm not going to go back to school and get a PhD. It's not even realistic. I was just deluding myself that this is where I want to go, and I kept convincing myself I was making progress when in reality I was headed this way. So I changed careers. And I decided I don't want to work in a government-supported industry anymore. I mean, there's a ceiling here. I'm never going to make any money. It's just not a lucrative industry. That's why I started an internet company. So I won't belabor this, and you can come up with your own definition, but I tell you, you have so much going for you, so much opportunity out there, but at the same time, you really don't have time to waste. And you don't get that many opportunities to make too many left-hand turns. You make them once or twice. Third time, your goal, you may make the choice. It'll just come off the page for you. You can't use up too many years in your career chasing something without knowing where you're headed and still just hope by luck that you're gonna end up at a destination that you really wanted to be at. So anyway, that's all I had to say today. It's